Many founders think tax is quiet until the first customer pays. No revenue, no tax pressure, no profit, no filing problem, no business activity, no record to manage. For a China company, that assumption can damage the operating record before the business even begins. The key idea is this: no revenue does not mean no tax work. After a WFOE is registered, the company enters a compliance rhythm. That rhythm may include tax setup, bookkeeping, periodic filing, invoice preparation, payroll planning, and accounting records even when revenue is zero. This episode is not a tax tutorial. It is about why early tax discipline matters for a foreign founder. The first hard anchor is filing. Late filings can trigger fines, often discussed in the RMB $2,000 to RMB 10,000 range, depending on circumstances. The exact outcome depends on facts, location, and handling, but the practical point is clear. Treating filings casually can create official record problems. The second anchor is late payment logic. Late payment can involve surcharge or late fee logic, commonly referenced at 0.05% per day. Again, the main point is not to memorize a number. The point is to understand that delay can become a measurable liability. The third anchor is zero filing. A company with no revenue may still need proper filing. Long periods of zero filing may attract attention or review, especially if the company later claims active operations, payroll, invoices, or foreign employment needs. The fourth anchor is bookkeeping. Founders often pay early costs personally: design work, travel, deposits, software, equipment, small vendors, temporary offices. If those costs are not recorded clearly, the company later has to reconstruct its own history. That reconstruction is harder than building the record correctly from the start. The fifth anchor is invoices. Invoice capability depends on tax and accounting readiness. A company may win a client and then discover that it cannot issue the invoice the client needs because tax setup was treated as a later problem. The sixth anchor is payroll and founder compensation. If the founder or foreign employee will be paid by the company, payroll, individual income tax, and social security handling, where applicable, become part of the employment story. If payroll is missing or informal, later work status or renewal records may look weaker. The seventh anchor is future procedures. Tax records can affect banking, invoices, payroll, hiring, and work status support. Missing or messy tax records can later contribute to bank account restrictions, invoice disruption, or a company record that is hard to explain. This is what asking too late looks like. A founder registers a WFOE and waits for the first contract before hiring accounting support. Months pass. Small costs are paid personally. Some expenses go through a personal account. A temporary office payment is not properly recorded. Software subscriptions are mixed with personal spending. No clear bookkeeping system exists. Filings are late or treated casually because there is no revenue. Then the company needs to function. A client asks for invoices. The founder needs a bank service. Payroll has to be set up. A work status file may need to show that the company is operating, but the financial story is incomplete. The company did not avoid tax risk by having no revenue. It created a record problem before revenue arrived. In a worse version, the company record becomes abnormal. Banking becomes harder. Invoices stop moving, and business pauses while the founder tries to reconstruct months of missing records. The framework to save is: no revenue does not equal no tax work. 1. Filing calendar. Know when the company must file, even during quiet months. 2. Bookkeeping. Record expenses, bank activity, invoices, and founder payments from the beginning. 3. Invoice setup. Do not wait until a client demands an invoice to check whether the company can issue one. 4. Payroll and tax link. If the company will employ someone, payroll must match the employment story. 5. Future procedure impact. Banking, hiring, founder work status, renewals, and contracts may all look back at the company's tax and accounting trail. The lesson: tax is not only about paying after profit. It is about creating the record that allows the company to operate credibly. For foreign founders, this record has strategic value. It can show that the company is not only registered, but alive. It can show expenses, activity, salary planning, client preparation, and financial discipline. It can support banking conversations, invoice applications, payroll setup, and later, founder or employee status planning. The opposite is also true. If the company has months of silence, personal payments, missing receipts, late filings, and no clear bookkeeping owner, every later procedure has to work harder to explain what the business has been doing. That is why the tax clock should be treated as part of the operating plan, not a back-office detail. A founder does not need to turn this into a tax lecture. They need a rhythm. Who keeps the books? Who tracks invoices? Who records expenses paid personally? Who watches filing dates? Who connects payroll to individual tax when hiring begins? If those owners are clear early, later business growth has a cleaner base. If they are unclear, every later request becomes a reconstruction exercise, finding old receipts, explaining old transfers, and correcting records under pressure. That reconstruction costs time. 10 questions foreigners ask too late can usually be reduced to one better question. What must be ready before the move becomes expensive?